Welcome to Roadmap to Retirement. Tune in for financial tips, investment strategies, and smart money moves to supercharge your retirement savings. Alex Neri, CFP, and guests are here to help you build your roadmap to retirement.
Nick, welcome to the Roadmap to Retirement podcast. So excited to have you here today. How's everything going?
It's going really well. I'm really excited to be here.
That makes
Thanks,
a lot of
Alex, for the invite.
Absolutely. So today's topic, we're going to talk about how to benchmark portfolios. This question comes about because there are a lot of clients or other people out there that want to know how they're doing compared to other people or whether or not their portfolio is doing well in general.
Yep.
In your mind as an advisor, what's the starting point to answering that question?
This question comes up a lot with clients, and I think a lot of people ask, hey, how's the market doing? How's my portfolio doing related to the market, to your point, right? I think honestly it depends on how they're invested, right? A lot of clients know, hey, I'm more aggressive, I'm more moderate in nature. We'll talk a little bit about what that actually means. But I think a lot of times people will look at what the stock market is doing, and then they'll look at how their portfolio is doing in relation to the stock market, and then look to see, well, the stock market was up 10% this year, my portfolio is up only 7%, what's going on, right? So I think that's a lot of times where the question marks start, if that makes sense.
Yeah, that makes a lot of sense. I think right from the start, what you mentioned about the stock market, where people say the market, and as advisors, I think we have to take a minute to clarify what does that actually mean. A lot of people see the Dow Jones or the S&P 500 and they refer to that as the market, where in reality that's just one part of the market or one index. So what do you think is a good comparison tool? So if somebody just wants a really simple way to say, I got X percent, the market, whatever that is, got Y percent, how do you compare those two things?
Yeah, so the S&P 500 is, I guess that'd be a good place to start, right? What's the S&P? The S&P 500 is a stock index, right? So there are 505 individual stocks, and they're weighted, and between all the weights that are in the index, they come up with how the market is actually moving as an average between those. That would be comparing something like more of an aggressive portfolio, which is going to be a lot of clients, the way we would explain it to them is anywhere between maybe 90% of your portfolio in stocks or above that, right? So 90, 95, 100% in stocks. It's probably not an apples to apples comparison because again, now we're talking about another stock market index, the Dow Jones, which is a much smaller index in the sense that it's only 30 stocks and there are different types. And we can talk about performance. I think last year was a good indication of a lot of how the differences between those work, but you're not invested in the exact same things. So I think that's going to be really one of the key points is if you're in an aggressive, more diversified portfolio, how do your actual holdings in there compare to the S&P 500 or the Dow Jones?
Sure. I think one of the problems with the S&P 500 specifically is because it is 500 plus different stocks. People make the mistake of thinking of that as a diversified stock portfolio, where the reality is it's still all U.S. large cap stocks. No reputable advisor is going to build a portfolio that matches the S&P 500. Yes, it might be one component, but it's still possible to be an aggressive investor and have very different returns than what the S&P 500 does. And that's a good thing because it means you're more diversified.
Yep.
I think just clearing that up. We nailed down how not to compare yourself, but if I did want to benchmark my aggressive portfolio against what other investors are getting, is there a way to do that?
Yeah, I think so. When we talk about an aggressive portfolio, we're typically looking at different types of stocks, right? So we talked about the S&P 500, which is large cap stocks, which are US based companies, the biggest companies in the world, right? These are going to be your Apples, Googles, Microsofts. But there's a lot of other companies out there too, and a lot of times they're categorized by size. So we look at smaller and medium-sized companies in the US. We might be looking at different indexes to look at, something like a Russell 2000. We'll track those. In diversified portfolios, we probably don't want to have all of our exposure just in US either, right? Because again, US does well a lot of the time. They're probably not going to be the best comparatively each and every year out there. So if we want to look at companies that are not inside the United States, more international in nature, there are other indexes for that. So a diversified portfolio is actually going to have your mix of small, medium, large size US stocks, probably should have some international exposure in there. And again, there's different layers to this too, probably not for this podcast today, but if you're gonna look at how your portfolio compares to that, if you're in just use some easy math, right? If you're in a portfolio that has 50% large cap stocks, let's just say maybe 30% in small and medium, and then 20% in international, that's not going to, comparing to the S&P 500 is actually probably not the right thing to do, right? Because only 50% of your portfolio is actually comparable, right? We have to look at, okay, what are the other indexes that are a little bit more accurate to compare to some of our other stocks in the portfolio. Does that make sense?
Yeah, it makes a lot of sense. I think as an advisor, one of the psychological hurdles that clients have is in a good year, or in a year that's good for, say, the S&P 500, they want to compare themselves against that, and they say the S&P is up 15%, and I'm only up 12%.
Yep.
What's the problem? And then in a bad year for the S&P 500, because they are more well diversified, if the S&P is, whatever, down 10%, but the portfolio is only down 3%, they forget to notice that. So there is some kind of natural bias built into it that I think you don't notice when it's in your favor. And there's a chart out there, I'm not sure what to call it, but the chart, it ranks the different asset classes each year. In 2023, this was the top ranked asset class, and then it works its way down. And if you look at the chart, it's interesting because you see that there's not a clear winner every year. It's not predictable. We know that some asset classes are in good years, some are in bad years, and our goal is to stay in the middle there and try to have sounds bad, but an average performing portfolio, because we want to cut off the low points and accept that we're going to cut off the high points at the same time. So it does make it more difficult to compare things, I think. And part of this conversation, part of this podcast was inspired by questions that we get a lot from clients, and that's, I was talking to my brother-in-law, my neighbor, whoever it was, and their guy got X%, but I got Y%, and why are they different? So I think one of the big pieces of advice is don't stop talking to your neighbors and your friends. Still talk to your neighbors and your friends, but stop trying to compare yourself to how everybody else is doing out there, because they have a very different financial situation. They have different goals, they have different risk tolerances, and your portfolio is not going to ever perform the same as theirs, and that's okay.
I think that's probably true for a lot of things in life, right? You shouldn't necessarily compare yourself to what your neighbor's doing or what your brother-in-law's doing or anything like that, but I think for this topic, it's absolutely true. Because unless you know exactly how their portfolio is built, with the exact holdings, the chances of your portfolio being exactly the same is very small, right? I think being mindful of it is a really good thing, right? You want to understand when you get those statements, you know what's in there. Advisors should be talking to you about that, what's inside your portfolio. And if you have questions, obviously you're going to be aware to some degree, some people more than others, of what's going on out there. Some people don't like to look at the stock market at all, which again, that might be a good thing, right? Just for some other reasons, but
I mean, we all have clients that come in for their annual review meeting. They say, I haven't looked at my account once, I never log in online, how's it doing? And on one hand, you think maybe you should pay attention, but also maybe ignorance is bliss, and there's really no benefit to losing sleep over every single move in the stock market. If you can pay the right amount of attention, check once in a while, but not too often and drive yourself nuts, I think there's a lot of benefit.
We find that people actually who check their portfolio less often tend to perform and have better outcomes, because they're not overthinking things. They're not thinking about, the market's up a little bit today, I really should sell here, or they're really not thinking about any of that, right? They're just letting things happen and making sure that they're checking with their advisor over time, but letting the portfolio do what it's supposed to do and making adjustments over the course of time is usually a winning approach, and we see that play out with people.
Oh, absolutely. There's a really good research piece out there by J.P. Morgan, and I don't want to quote this wrong, but basically it shows the market return being around 10% each year, not 10%, and then it shows the average investor getting a little bit less than 3%, I think. We'll check those numbers if we need to. And the reason is that the average investor is getting emotional, and when the market's doing really well, they say this is a great time to jump in, and they buy. When the market's not doing well, they get scared, they pull out, and that's really the opposite of what we want to do. We always want to buy at a low point, sell at a high point, and not knowing when those times are. People either try to time it and time it poorly, or they get emotional and get out at the wrong time. So it goes back to what you're saying, that if you just put the blindfold on, invested your money, invested X amount of dollars every month throughout your career, you come out way further ahead than the person that talks them into thinking that they know something that they can't possibly know.
There is a point I do want to come back to with what you were talking about before. That chart, that's a Callan chart, by the way.
There it is.
That just came.
I was blanking on the name. That's why you're here.
That's why, exactly. The reason why I think that's important is, over time, obviously, we want to try and get the best rate of return we possibly can, right? And you talked about if the S&P's up 15% in 1 year, and all of a sudden my portfolio is only up 12, that's something to be mindful of when the market's going up, but then there's also value when the market's actually going down, right? If we're down, I think the example you gave was we're down 10, market's down 10, we're only down 3. That's going to be really helpful for your portfolio over the long run, right? So, just a very easy example that I use in my client conversations is if you took even just $100 and you were down 10% from there, you're going to be at $90, right?
That's true.
That's
The
true.
math.
So the flip side is, then I'll ask people, if we just got a 10% return from there, how much money would you have?
99.
That's correct. A lot of people actually say 100 because and if you don't, just at first glance, it sounds like that would be the case, right? I'm down 10, up 10, your average rate of return is actually 0. But you actually still lost money. To your point, you're at 99, 10% on 90s now, only $9, right? So, you could actually have a 0% rate of return in that example, but actually still be down money. So the key is if we can have a portfolio constructed the right way to limit some of the downside, that will help you ultimately recover and then start growing. This is proven to be very beneficial for your portfolio long term as far as risk and how much money you have at the end of the day. But that's a practical example of why diversifying your portfolio, maybe not being exactly how the index is, could really benefit you over the long run.
Yeah, that's a great example. And talk about a frustrating situation for the average investor who doesn't have the time that we have to think about this stuff to open up their statement, say they have a positive rate of return, they lost money.
Yeah.
Or there's another situation in a non-qualified or taxable account where they can lose money and have a taxable gain. That'll be a different conversation.
That's a different podcast, but that is also it's very important too.
Yeah, and if you're trying to navigate this stuff or you're new to this stuff, what would be more frustrating than losing money and having a positive return?
Yep.
I think that's a good one. What else should investors be thinking about? They think about the rate of return, or if they're just trying to see if they're financially healthy or they're doing the right things. What are some other things investors can look out for?
Yeah, I think rate of return it's very important, obviously, because getting a 10% average rate of return over time versus a 7% average rate of return over time, especially for someone with a long time horizon, they got a long way for their money to grow. That's going to be a huge difference. We know how compounding interest works. But it is also just one piece of the pie, right? Going back to the example of maybe looking at what other people are doing and what your brother-in-law is doing, et cetera. Everyone is also in a unique situation, right? Everyone has different retirement goals. Everyone has different spending needs. So the reality is, two people who might even be the same age, they might be similar demographically, just where they are in their life. Those two families, individuals might have completely different goals, right? One family might want to spend $10,000 a month to live the lifestyle they want. The other family might just be very comfortable with $4,000, right? Those two people are going to have vastly different financial needs that go well beyond rate of return. The person who gets $4,000 a month, if they got a 10%, they might need that 10% rate of return to actually fund their goals versus the 10,000 might only need the 7. And again, that probably doesn't make a whole lot of sense just as we're talking about it, but that's part of why we go a little bit deeper with this stuff to look at, okay, to generate that on a monthly basis, we're going to need a certain amount of money and to be able to look at where they are today and what they need to do versus the second family. Again, rate of return is super important, but then as you can see, just even as we're talking about this right now, there's so many different factors that come into play, and it really starts with actually looking at what you actually need and when you're going to need it.
That's the big point. I think a lot of times people fall in this trap of a higher rate of return is always better. If I can get more, why wouldn't I?
Yeah.
And if you start to align your investments with your actual goals,
Yep.
like for example, if you're a retiree, you just retired, you've done a great job saving, yes, you could search for a bigger return because who doesn't want more money? But the reality is if you can invest in a more conservative way, take some risk off the table, and objectively look at the portfolio you have, you might say, I have enough money here to do everything I want to do for the rest of my life. So why expose extra risk and potentially lose out on doing something you want to do?
Yep.
Just because your neighbor says they got X amount of rate of return, you want to keep up with them.
Yep.
So align your goals. And the same thing on the younger side. So younger clients should be taking more risk because they do need to fund that goal down the road.
Yep.
But to your point, everybody's situation is different. One example I also like I think when people start working with financial advisors, the first thing they always think about is the investment performance or what their stocks are doing. And I spend a lot of time talking about tax planning. One of the reasons I do is if you have a trade-off where you get maybe 1% better rate of return, but you increase your taxable income or whatever it is by 5%, is that worth it?
Yeah.
Do we want to give away an extra 4% of taxes to just make an extra 1%?
Yep.
So it becomes a situation where you're not seeing the forest through the trees or the trees through the forest, whatever that saying is. But I think people struggle with that mentality a little bit.
Yeah, it's really hard. I think we naturally just compare ourselves to what our peer group is doing or just family members and what have you. And again, these things come up at family parties or politics. These are the things that do tend to come up. So it's very natural to start that comparison. So it's not anyone's fault that it occurs. I just think having, and this is why we want to do this conversation, because I think just having that perspective in mind to say, okay, they're doing this, but I know that based on what I've talked about, we have a plan in place. We're still on the right track, right? You definitely want to be mindful of, again, I think if you have a situation where the market's up 10% and you're supposed to be aggressive and you're only up 2% a year, maybe it's good to get that checked out, right? So again, all this stuff's relative, but I think if you're looking at it through the context of where do I personally need to be in the future, what's my own personal financial goals, that can keep us looking at the right thing, tuning out some of the other noise that's out there. Yeah.
Here's a fun question.
Okay.
You're not prepared for this one. I find myself a lot of times in social situations where there's two other people talking. I'm not necessarily part of the conversation, but they're talking about something financial planning related, whether it's investments or something else.
Yes.
And the things they're saying are just objectively incorrect. Myself, I always choose not to interject. I just listen and take mental notes, and that's fine because they're not asking me. I'm not at work. So what do you do in that situation when you hear two friends talking to each other and they're just saying things that are incorrect?
Yep.
And maybe you're hesitant to step in. Do you step in?
Maybe.
It's not always welcome. And you don't always be that guy, but it's...
Yeah, I think one of the things I've learned over the course of my life is some people just giving unsolicited advice doesn't work in many scenarios, right? I think it depends. Again, a lot of this stuff depends, right? I think it depends on your relationship with those people. I think it depends on what they're talking about. You can choose to interject, maybe bring a sense of humor or something that might make it a little bit easier to have that conversation a little bit. Or, again, ignoring it.
Ignoring is probably always the best thing to do. Anything in life, just ignore it.
Just ignore it.
I kind of compare it to when you're at the gym and you see a guy working out, he's just doing something wrong.
Just the form's wrong.
That guy's going to hurt himself, but then there's no way to go over and correct his form. Nobody wants to have that conversation.
Yeah, unless it's really bad. Okay, man, you might actually break your back right now.
Yeah.
I might go in there and say, hey, let's just do this, but then
You're better than I am. I just put my headphones on.
Yeah, so if they're going to do something that's going to cause immediate financial, like immense financial harm, then yeah, I think let's go in. But usually it's just some piece of advice they saw on the internet that, again, is just objectively not true and probably doesn't apply to most people. So, yeah.
We'll do the whole episode on the internet and the things that you hear, but
yeah.
Thank you for your time. We're going to wrap it up. We'll give you one more thing. What's one more thing that everybody should think about in terms of financial planning? Your best tip.
My best tip?
Yep.
I guess just in the context of what we're talking about here is, put me on the spot here.
I am.
Yeah.
Yeah, this is good.
Yeah, I think you want to have someone you trust working with you. And again, obviously we're financial planners, so we're going to be clearly biased and we can talk about a lot of reasons why you should consider that, right? But I think the biggest thing is you want to have someone that you trust who's going to look out for you and not, again, as objectively as possible.
I think that makes sense. You just don't want to constantly feel like you're worried about, are my investments doing right? Because you're working with somebody that you trust that is doing the correct thing for you.
And who's looking out for you and your best interests, because you can go down a rabbit hole of, again, what everybody else is doing, looking on the internet. There's different Facebook groups out there. There's so many ways that people will get just advice in general these days, and I think you just have to consider the source of that information. So I think that's probably the biggest thing. So whether you're going to work with a financial planner, whether you're going to, go try and do things on your own, I think if you have a trusted source of information, people who you can bounce ideas with, I think that's probably the biggest thing.
All right.
That's
Good
how
advice.
I
I like it.
Yeah.
Sorry to put you on the spot, but
Okay.
thanks for being here. We appreciate it.
Yeah.
And this has been the Roadmap to Retirement podcast. And until next time, we'll see you.
Thank you for having me.
Disclosure. Content here is for illustrative purposes and general information only. It is not legal, tax, or individualized financial advice. Nor is it a recommendation to buy, sell, or hold any specific security, or engage in any specific trading strategy. Results will vary. Past performance is no indication of future results or success. Market conditions change continuously. This commentary reflects the personal opinions, viewpoints, and analyses of Alexander Neri. It does not necessarily represent those of RFG Advisory, their clients, or their employees. This commentary should not be regarded as a description of advisory services provided by Alexander Neri or RFG Advisory or performance returns of any client. The views reflected in the commentary are subject to change at any time without notice. Advisory services offered by investment advisory representatives of RFG Advisory, a registered investment advisor. Alexander Neri and RFG Advisory are unaffiliated entities. Advisory services are only offered to clients or prospective clients where RFG Advisory and its representatives are properly licensed or exempt from licensure. No advisory services may be rendered by RFG Advisory unless a client agreement is in place.